From WBRN Radio and on the Bostonred Network. This is the Numbers Man Show on the 15th of December 2019. We'll take a look at the market, where it will be in 2020, sort of as a little preview via CNBC. And we'll look at the Producer Price Index and several other indexes here, the number of unemployment claims filed, but that in itself is incomplete because, again, we are dealing, this is for November, we're dealing with incomplete data. Therefore, it will change. You can expect that to change in Q1, and we'll get a better look back in Q2. That's in 2020. Retail index was basically flat, and that would cover November, which would be the sales days. Black Friday had already been flat, but again, we had Cyber Monday and Buy Local Wednesday, Saturday, various opportunities there, and of course the world of online is generically called that. The Amazons of the world, Walmart, and various other retailers out there, the Targets, the Best Buys, and you name it. We're out there selling various types of electronics. A tentative trade deal with China called Phase 1, or we'll call it the Little Deal, basically says, and we don't really have the outline yet, but China would buy more poultry products and agricultural products, I guess we should say there, and that's from it would benefit the farm sector, soybeans and what have you, and also they'll be buying pork. I don't know the pork belly's price. I always used to like to get it. Anyway, don't have it, but nonetheless, China lost about 40% of its pork supplies to the swine flu, so therefore they are replacing that particular situation. But one word here is that in terms of farm products, there are other countries in the world that produce soybeans. Brazil is brought out here, Argentina, etc., that are also there, and what China has had to do in the absence of the U.S. Part of their puzzle, they have relied on other markets, so that ecosystem starts to develop. On the other side, some tariffs, they have put them on hold for now, and China has taken some off. But in the so-called tech sector, that's products that are produced for the iPhones, etc., the Intels of the world, their chips, Broadcom, and various people that manufacture those. What is starting to change, that landscape is changing. China is definitely in the hardware business, no doubt about that. It is only a matter of time before they get into the wafer business. That's the microprocessors, etc. They make a lot of other things, but they're getting into that. Now, I was listening to a webinar, something of that nature, was talking about China and their software business. Well, China entry into software through the open source movement. Incidentally, this week we will have an open source report on this channel on the same weekend, come from WBRN Radio. So we have a number of things coming up here, and we also have the Monday morning quarterback. But back to the issue at hand, the economic part of the puzzle, just looking at, we'll get to some of these predictions, and this is from Trading Nation part here. Wall Street predictions a high single digit again next year, what history shows this is likely wrong. This is by Michael Santalilli, anyway, right here, hopefully. And this is some of the so-called key points here. The survey showed a medium prediction. This is for the S&P 500 2020 gain of 6.5 to 3,375. But since 1928, the S&P has shown a gain between 5 and 10 points. That's the old investors back in the day when we used to do a timing model around here at Cranston Analytics. We consensus, if you talk to Warren Buffett and the others, consensus 5 to 10% there. This is 6 out of 91 calendar years, suggesting the consensus for a forecast high single digits in 2020 has a 93% chance of being wrong. Anyway, Wall Street predicted a recession would be avoided. That from this mic, very skeptical of that. The global economy will pick up in the coming months while U.S. GDP returns towards a long-term trend of around 2%. China is forecasting theirs from 6 to 6.5. The first part of the year should be strong, they predict, but expect more volatility ahead of election time. Well, the people that forecast elections would like to see that, no doubt about it. A long ago world leader famously called politics the art of possibility. The strategists, for their part, impresses the art of the, as Wall Street strategy, the art of the plausible, knowing that financial markets in any given year are inherently unpredictable. They construct a reasonable forecast using unconventional assumptions. Yet this is perfectly plausible. In other words, not at all probable the ultimate outcome. The S&P 500 on any given year falls between 5 and 10 range. Right now, the CNBC people show a medium prediction of 6.5 there. We can just name that. The average forecast is up 9%, and the maximum target is now 34.50 by Julian Emanuel, which would put the advance at about 9%. Yet, counterintuitively quirk, the short-term almost never conforms to the long-term average since 1928. The S&P only shows a gain between 5 and 10, and suggesting the consensus forecast for the high single digits, 93% chance of being long. So I'm repeating some of this, but again, if we look at stock in 2019 will surge by more than this was not a popular outlook, more than 25% for the best year since 2013, while corporate earnings finish about flat and long-term treasuries will return more than 10% of the Fed deals to cut rates 3 times, and successful round of tariffs imposed China halfway through December. Hardly a plausible sounding story at that time, but exactly what happened on the year here. Let's see. The index earnings followed last year's negative equity returns in a year when profits surged by 20%. The 2019, this is their index, at 3168.80. None of these is to denegate the performance of the brokerage house strategies. For those arbitrary index targets are small and a thankless part of the job. Well, anyway. BlackRock Investment Institute comes close to distilling this general view. Growth edged high in 2020, limiting recession risk. This is a favorable drop back for risk assets, but the Dovey Central Bank pivot that drove the market in 2019 is largely behind us. Inflation risk looks underappreciated, and the looming China tension could end. That leaves us with a modest pro-risk stance for 2020. From RHB Capital's Laurie Convencier, we predict 2020 to be a year of moderation, and that's what we've heard from a lot of people, including the people at Michigan, the people at SHHSB here market. The transition equity markets, down years are rare in equities outside of periods associated with growth scares, recessions, and financial bubbles. Of these scenarios, unlike in the year ahead, we expect 2020 to be another positive year for equities. But down years are rarely, certainly worth remembering, no doubt. One notable tendency, this is from A.C. O'Hare of MKM Partners, that points out since 1950 there have been 18 years when the S&P has gained at least 20%. The following year it was up 15% of those times by an average total, including dividends of 11% of those down years following a 20-plus gain. Two involved a recession that was in 1981 under Reagan and 1990 under the first President Bush. 1962 was a rare non-recession mini bear market. The very broad composite index, as from the NYSE, last week made a record high for the first time in 2 years. Since 1980, it's gone more than a year without any new highs. 1 year after a new record was finally set, the index was up a year later, all 8 times, for a minimum gain of 14. So you're not getting the fantastic up and downs that you would expect. Let me just finish up one little sentence here. Stocks reaching highs with the credit market, a perceived scarcity of cash flow producing assets globally, and no outright overconfidence yet being shown by investors. Stocks enjoy tailwinds that keep alive the prospect, but the market could start running well ahead of the plausible pace now predicted by Wall Street handicappers. Well, it's very, very difficult to predict on Wall Street there as to where the market will be. There's always some optimism, and by its very nature. This is also from CNBC. Eric Rosenblum here. The stock market has set a new record during the Trump's impeachment process. And in this article, they look back on the only one that they have. Consumer confidence readings are second only one that Bill Clinton impeachment, that was in 1998. If you remember, there was a dot-com boom going on there, a little different situation. Americans are a little more likely to view the impeachment proceedings, like most other current political issues, through a partisan lens. There's no doubt about that. And they have some surveying here. And to the University of Michigan, we went through this, was the last week or week before last, even though the index took its biggest tumble, that was in since 2012 in August. It fell and had been a general trend since 2007. In the past 35 months, the Michigan Sentiment Index was 95 or higher. That's a level of optimism. From Dr. Curtin here, I heard him interviewed also on NPR. Although the impeachment process occurs at both times, in the early periods it didn't cause an loss in confidence. Virtually no consumer, 1%, mentioned impeachment in response to any survey in early December, where the confidence dive in August, and 1 in 3 mentioned tariffs. So it has been there, and this is sort of what has actually happened here. On the morning of the impeachment, the House Judiciary Committee voted. The S&P 500 was up 26.4% for 2019, the Dow Industrial Average, and the NASDAQ were up 20.6%. That was the S&P was up 20.6%, and the NASDAQ was up 34.4%. So really nobody was paying attention to that. From Lynn Franco, that's at the conference board we did theirs, I think, last week. What has caused some softness in consumer survey numbers is how good the economy and consumer confidence has been. We've hit a 19-year high in the fall of 18. We have been sort of moving sideways, that's according to Franco. She said any dip in the past year that could be tied back to politics has been trade related. Trade is a political issue, no doubt about that. Consumer confidence remained much higher than CEO confidence. We talked about that. And this is a survey here, a recent CNBC Acorn Investment in You survey found that only 21% of Americans say they are worse off today than they were in 2016. Of course, that was an election year. Amidst a historic low in unemployment, strong consumer spending, well, it was not as strong. Amongst Republicans, 42% said the economy would be the main issue in 2020. That figure drops to 27% for Democrats. Although 79% of all Americans say it's important to support a presidential candidate who will help improve your own financial situation, even amongst Democrats. Less than 50% believe a Biden, Warren, or Sanders presidency would improve their personal financial situation. But if asked if Warren or Sanders presidency would make them more fearful about their personal finances than a second Trump term, more than 60% of Republicans said it would, while only 20% of independents. That's a good figure there. From a political standpoint, and 13% or less of Democrats. We have a great economy. We have been in it for a very long time. So until it changes, people want to have reason to think or see anything differently. That's from Laura Wonsky, a senior research scientist at the Monkey Survey. The partisan divide exists amongst small business owners. In Q4, the survey there found that Republican business owners are much more likely to say impeachment would be bad for business. At no other time in the past century has divisions in economic expectations been so wide amongst consumers. That's from Dr. Curtin. The average gap between Democrats and Republicans, 18.7% in the Obama administration. And, of course, again, they were coming out of a depression, and 41.6% in the Trump operation. Economic expectations of Democrats and Republicans are clearly exacerbated. Michigan found independents represent the largest groups that are less susceptible to maintain partisan views and hold favorable expectations. From the Pew, and I think I have a different Pew survey here, it found, this is in 2017, that 32% of Americans now take a roughly equal number of conservative and liberal positions. The Clinton affair, that was with Monica Lewinsky a long time ago. The S&P was at 39.2 high in the year after the process began against Clinton, and was down 33.4 after the proceeding started against Tricky Dick, Richard Nixon. But again, you did not have during Nixon's tenure.com bubble. They didn't mention that. I'm surprised at that. How actual consumer spending, though, has been declining in recent months. Retail sales came at a level much weaker than expected. That was on Friday. We'll get to that one a little later here. And I think we're finishing up this part of it. Short-term thinking that distance us from long-term investing. If you're reacting to this is likely because you don't have a plan you can stick to in the first place. Well, I don't know about all that. That was from somebody named Bonaparte. He is a Douglas Bonaparte, member of the CNBC Advisory Council, president of Number of Americans filing for unemployment jumped to a 2-year high last week. Likely did not signal a pickup in layoffs, as claimed data tends to be volatile, no doubt, during the holidays. And it surged to 252,000 for the week, ending in December the 7th, the highest reading since September 2017. That rating there, well, see. And initial claims for state unemployment benefits surged 49,000 to a seasonally adjusted 250,000 52,000 for that week. The Department of Labor said the increase was the largest since 2017, August of that year. Claims had dropped 203,000 in the previous year. Well, it's going to go up and down a little bit here, so you're not going to see much going on here. I didn't look at the U6 figure here, but it's about 7% or something like that. Claims report also showed the number of people receiving benefits after initial week of aid dropped 31,000 to 1.27 million for the week ending November 30th. The 4-week moving average, the so-called continuing claims, fell 6,250 to 1.68 million. So that's where that is. And producer price, I'll just give this and I'll go to the actual index in a minute here. Producer prices won't expectedly change in November. Data points to muted inflation despite a recent uptick in consumer prices. The flat reading in the index for final demand last month followed a 4/10 surge in October. And were unexpectedly unchanged, Labor Department said Thursday. The flat reading in the index for final demand last month followed a 4/10 surge in October. In the 12 months running there, the PPI gained 1.1%, matching the October rise, the smallest since October 2016. The economists at Reuters had it at 0.2% in November, an acceleration of 1.1% year over year. So that's basically where it is. The core PCE index rose 1.6 year over year basis in October, and it fallen short of its target this year. The Fed on Wednesday, of course, the interest rate stayed there. And the report last Friday that it added 266,000 jobs, and the unemployment rate fell back to 3.5. Wholesale energy prices increased 0.6% after rebounding 2.8 in October. That has been down. Goods prices rose, so forth and so on. The cost of services dropped to 0.3 last month, the biggest drop since February 2017, reversing the October gain of 0.6. Healthcare services fell in November to 0.2% in November after accelerating 0.8 the prior month, and so forth and so on. Healthcare costs fed into the core PCE price index, which is also into calculating core PCE price index, rebounded 1.2%. So let's go over to it here and take a short break while we transition. WBRN Radio. Hey, from the Bureau of Labor Statistics, is released on Thursday, the 12th of December. The producer price index for final demand was unchanged in November, seasonally adjusted. The U.S. Bureau of Labor Statistics reported the final demand price rose 0.4 in October and fell 0.3 in September. In November, the 0.3 rise in prices for final demand goods offset by a 0.3 decrease in the index for final demand services. The index for final demand services, less food, energy, and trade, was unchanged in November after inching up 0.1% in October. For the 12 months, prices for final demand, less food, energy, and trade, moved up 1.3%, the smallest advance since climbing 1.3% in the 12 months ending in September of 2016. And the index of final demand goods increased 0.3 in November, followed by a 0.7 advance for the final demand in food. And the index for final demand in energy and for final demand in goods, less food and energy, moved up 0.6 and 0.2 respectively. Product detail: the major factor in the increase in prices for final demand goods was the index for meat, which climbed at 3.9%. For gasoline, chicken, eggs, diesel fuel, fresh and dried vegetables, and tobacco products also moved up. In contrast, the index for residential electric power fell 0.6, and for unfinished and industrial chemicals also declined. Final demand services, the index of final demand services moved down 0.3 in November, the largest decrease since falling of 0.3 in February of 2017. Overall, 2/3 of the broad-based decline in index measured change in margins received by wholesalers and retailers' prices of final demand services, less transportation, warehousing, and final demand transportation warehousing service fell 0.1% and 0.3% respectively. Margins for food wholesaling, which dropped 5%, was a major factor in November's decline in prices for final demand services. The index for hospital outpatient care, machinery, vehicle wholesaling, airline passenger services, professional and commercial equipment wholesaling, and security brokerage, dealing, investment, advice, and related services also moved lower. Conventionally, prices for travel accommodation services increased at 3.6%. Index for equipment, parts, and supplies wholesaling, and for long-distance motor carrying also rose. And it's just listing some of what was going on here. And this is back to November. If we look at 2018, energy was down 5.8%. We look November, what do we get? For immediate demand in November, the index for processed goods increased by 0.6. Prices for unprocessed goods rose by 3.9%. The index for services edged down 0.1%. Processed goods for intermediate demand moved up 0.2, following a 0.4 increase in October. The index for processed feeds increased by 1.4%. In contrast, prices for processed materials, less food and energy, declined 0.3% for 12 months, ending in November. The index for processed goods and intermediate demand fell by 2.9% in the 7th consecutive month. 12 there. Prices for gasoline, meat, natural gas, electric utilities, commercial electric power, softwood lumber also moved up. Conversely, the index for industrial chemicals fell at 1.4. For steel products, the resulting fuels also fell. On processed goods, we talked about that one. I'll skip it by doing a little bit of deep diving on some of this at the information you sometimes don't get other places. Prices for services, November decrease was 0.2%. For warehousing services for intermediate demand inched up 0.1. Prices for services, less trade, transportation, warehousing for intermediate demand were unchanged. Prices for stage 4 intermediate demand advanced to 0.2 in November. The index for total services inputs was unchanged. Increases in index for diesel fuel, machinery, equipment, parts and supplies, wholesaling, portfolio management, gross rents of rental properties, accounting services, partial outweighed declines in index there. So, okay. Higher prices for fuel, crude oil products accounted for services partially here, and total services input declined 0.4. Advances in index for diesel fuel, carbon, steel, scrap, gas fuels, crude, petroleum, machinery, travelers' accommodation. They throw many things here together. Outweighed declines in loan services, chemical industry, security brokerage, dealings, investment advice. Anyway, the next index is scheduled for December. Is scheduled on January 15th. So that'll be the next price index. And that will do that one. Let's move along here. We already mentioned China growth. This is from Reuters, incidentally, about 6% to I've seen the figure 6.5% there. And this was at an annual Central Economic Work Conference this month. This is in China. Economic growth 6%. To meet the goals, expected to expand to about 6.2%. They could go as far as high as 6.5%. Annual budget deficit could rise this year to 2.8% of GDP, but this is likely to be kept within the 3-point range there. Local governments could be allowed to issue special bonds of 3 trillion yuan. That's something yuan. Excuse me. That's something like $426.20 billion, and financial risk will be taken care of there. I don't think one has to worry much about it. In Argentina, I think we talked about the hike there in Argentina on soybeans and soy meal. This is the rate 30% from 25%, and lift the levy on corn and wheat to 12% from 7%. Beef exports, these are exports, to be taxed at 9% from 7%. They were at 7%. So there will be some hike rises there because of the restructuring there, $100 billion of debt. Argentina is the world's third corn and soybean exporter, top exporter of soy meal. Now that is a feed for agriculture. So they're a very big market there, no doubt about it. But it will cost more to deal. Argentina has the largest maturing debt in 2020. Tough financial situation. The International Monetary Fund as a part of a $57 billion standby loan, a deal agreed. It was in 2018. And the new leader there has asked for that particular situation to be revamped, and it should be revamped. Take one look here. We have a reduce the price index. We get these in various forms here, so okay, this is retail sales, and make sure this is also in December the 13th. Advanced U.S. Retail and food service. The estimate here, as adjusted for seasonally adjusted, there at 528 billion, an increase of 0.2 there from the previous month, and 3.3 above November of 2018. Total sales for September 2019 through November 2019 were up 3.5% for the same period a year ago. The September 2019 to October 2019 was revised from up from 0.3 to 0.4. Retail trade sales were up 0.3% from October of 2019 to 0.1% above last year. Non-retail trade was up 11.5% from November 2018. Food, drink, and services were up 5.1%. Now, let's get the general information here. Of course, that'll be released next year. Second, we'll do a little bit of deep diving here. We won't do a lot of deep diving, but anyway, this is estimated monthly sales for retail and food services by the kind of business. I'd like to look at this. 11-month total retail sales at 5640,659, and that would be 2019, and the change there was 3.4%. Now we dive down a little bit here, and that was 5 trillion there. Anyway, motor vehicles at 1T have changed there, 3.9%. It was 3.8. Furniture and home furniture stores, they were at 0.4% for them. Electronic and appliances down 3.7 in the negative there. Building materials at 0.4. Food and beverage at 3.1. Health and personal care stores 2.9 percentage change from 2018. Close a negative 0.6 there for that. We go to instruments and bookstores, negative a 2% there. General merchandise stores at 1.4%. And food and drinking places at 4.5%. Had a better year there. Non-retail stores at 12.1%. And miscellaneous retailers at 3%. And these are some of the estimates here in October. It was at 0.2, and it's now at this is retail and food service 3.3. Motor vehicles and parts dealers at 0.5. That was in October, and it's 4.9. That was in 2018. Let me get over that. So you kind of look at a little better trend for some not. Food and beverage stores, they were up 2.9% there. So again, different measurement. I won't get into medium error. We won't really get into that. But basically speaking, it was a weaker report than was expected. Let's see, it's 5,500 employer firms selected from a larger retail sales survey. And this is food and beverage service who sales have been weighted, and sampling error here at 1.2% is estimated here. So kind of look at what is basically going on here with this information. Back to the top. So thus, this was November. The adjustment here, just to go over this, 528 million on an increase of 0.2 from the previous month, and it was 3.3 above last year. So again, retail sales actually were up a little, but if you remember, last year was not a great year for the retail sale operation. So I guess if we sum up in this year's report, what we basically have had is an economy that, if you look at the market has basically done well this year, 2019. It's had its ups and downs, the inversion curve there. As far as bonds, I don't have the bond reading, but let's go and do the numbers, and we'll get some of this. See if we can steal this from Reuters here. We'll go to the BBC to do the numbers. And where are we with the BBC? Ah, yes. Anyway, these numbers were on the 14th that we pulled down here. The FTSE 100, we usually do it, was at 79.97 in London. That was after the election. In Amsterdam, they were at 3.15. In France, at 37.76. The DAX in Germany was at 61.08. The Euro Stoxx was at 24.72. And in Madrid, they were 95.21, or they were up 1.01%. Quickly go Bombay. They were at 428. Or 1.05%. That was the change there. The Hang Seng was at 693.62, and the Nikkei was at 598.29. Now this is the preliminary deal, a mini deal between China and the U.S. on that trade talked about. And just looking at a basket of currencies here. Well, let's do the Dow, then we'll do Brent crude. Was up. The Dow was 3.3, 1/10% change in the Dow Jones, and Nasdaq was at 17.56.20% change there, and the S&P 500 was at 0.23 or 1/10 change there at 28.13. Was going up to 2,800. So-called magic number there. Let's look at Brent crude. And Brent crude futures, $65.22. And it's a $1.02 change there. West Texas crude, it was at $60.07. and the change was 89 cents. T. Boone Pickens' relatives are dancing for joy, I suppose, with that. And gold was at $1,474.70. That's on the Forex index there. And basically, well, look at the PM here. It was at 1,000. It gained $1. And where was old natural gas? Natural gas was down, not futures and what they had in line, I suppose you'd say. And with this was the BBC. And one other quick look at the BBC business here, just to make sure we didn't miss anything of substance here as we wind down. Big headline here is Trump halts new tariffs on China. Well, that was part of the so-called deal period. Looking at Brexit and where Brexit will go. As we go along here, we'll have more information here on what's going on. Headline here, picture of Boris Johnson at some place, who knows where he was anyway, in a white coat, 3X size. They urged Johnson to secure trade deals. Well, these trade deals go both ways. It takes a bit of time before these trade deals are secured. And we don't have any numbers on the UK as to where they are in terms of this. This is from the Pew people here. I won't really go into the survey. We'll do it on the political side. This is on the 11th of September. The Pew people, roughly half of low-income Republicans, say current economic conditions are hurting them and their family. And we'll say by many measures, the U.S. economy is doing well. Unemployment is in the 50-year low. Despite these indicators, public assessment of the economy are mixed. Majority of upper income, middle income Americans say current economic conditions are good, excellent, but only 4 in 10 lower income share this particular situation. Views of the economy is strongly linked to a partisanship with Republican independents who lean toward much more likely than Democrats and Democratic leading counterparts to have a positive view of the economy. So we look at the numbers here. People who are middle class, well, yeah, they do have a different situation here. Basically, saying 58% of them, people who are poor, 64% in your family. Well, to the extent that the current economic conditions are helping particular groups, the public sees the benefits flowing mainly to most of the well-to-do, roughly 7 in 10. 69% say today's economy is helping people who are wealthy. Only 10% of the wealthy are being hurt. When they asked about economic conditions affecting them and their families, there was a little bit of this in the monkey survey we had earlier here. Nearly half of the adults, 46%, say they are being hurt, 31% saying they are being helped, and 22% say they don't see much impact. A variety of factors go into Americans' assessment of current economic conditions, the most prominent being perception about wages and incomes, availability of jobs, healthcare costs. Two of these three factors also have a significant impact on people's own financial situation. 51% say wages have a great deal of impact on their household finances. 43% say healthcare. The overall job situation seen as less personal revenue. Instead, 45% of consumer prices have a large impact on their own financial health. Consumer prices, yeah. A look inside the financial lives of Americans revealed that enormous gulf in day-to-day challenges and worries about that lower income and upper middle income adults experience. 2/3 of low income, 65% say they worry almost daily about paying their bills, compared with 1/3 of middle class people, 35%, and a small percentage of upper class people only get more credit. The cost of health care is also worry that weighs on the mind of many Americans. More than half of low income, 55%. Incidentally, today is the last day, by the time you get this, it'll be over, to sign up at the Affordable Care website. National Representative, this is a survey of 6,878. A good survey was conducted on 29 people. Majority, 59%, said that their current economic conditions of the country are excellent or good, including relatively few, 10% as excellent, 49% said they are good. Roughly 4 in 10 Americans say, 44% said current economic conditions only fair, and 8% poor. So you can kind of see the perceptions here of how all of this has come together. I think I read that twice. And about a third or more of adults say consumer price in food, 37%, and the country's tax system, 38%, and the federal deficit, I hadn't heard that, 32% contribute to a great deal of their view of the economy. Somewhat less important is real estate prices, it's only 27%. Stock performance, 25%. Gas price in the area, only 23% there. So matters most, wages, job availability, and healthcare costs. I don't know if this particular survey went into low-income Americans. Say price of food and consumer goods affect their household financial situation a great deal. That is 57% of them, 46% of middle income, and only 22% of the upper income. Well, they're not the same deal. The cost of health care affects low-income, middle-income households to a greater degree, and that is the case. About half, 49%, and 46% of middle-income people. It's kind of where the economy is. These surveys pretty much bore out each other. About 7 in 10, that is 69%, say that current economic conditions are helping people who are rich. Well, that particular situation is out there. Democrats are more likely than Republicans to say the current economy is helping the wealthy. That's 77% versus 63. 63 is still fairly high. Majority of Americans say the economy is not working to benefit several other key demographics. Roughly two-thirds of Americans, 64%, say that people who are poor are being hurt by the current economic conditions. No doubt about that. But, again, that is a lower percentage. Lower-income Americans are twice as likely as upper-income Americans to say the economy is hurting them. Well, no doubt about that. This survey is consistent with other surveys. And what you have to look at is where the majority of American people are. And, of course, these surveys are weighted to put that out. If you're in the upper or the middle income status, I would suppose what's a family for about $50,000, you're not hurting as well. And, of course, that would depend, obviously, on what you pay for rental costs and various other things, where you live. In a place like San Francisco, you could make $50,000 and be living in a room, or maybe in your car. So in other words, it would really depend on where you are as to what you're doing, and also how many jobs you have. That is the crux of the whole argument there. This will wind us down. For those in business, make next week a productive one. For consumer, obviously the eye is on the ball, and happy holidays for all. We are aware that various holidays are going on, Hanukkah and New Year's coming up. Thanksgiving he went out of, and obviously people that are driving, a lot of the flying was done on Thanksgiving. Some people I talked to, actually, they now celebrate, for families that is, or whatever get-togethers, the Thanksgiving Day much more so than the Christmas holiday. It's more light, but many people, I know Carla did her Christmas shopping back in, late September, early October. So people are finished. So that a lot of that does complicate the traditional holiday spending, because people have already spent in the past tense, and if they've already spent, they're probably not spending again. And people usually buy for basically Q1. In other words, if they need winter clothing, they probably bought that back in September or whatever, and perhaps other kinds of things. That's why you see a lot of electronics bought it there. The buys are out there, the television sets, etc. But what further complicates some of that in the electronic field is the mobile phones, smartphones, etc. The 5G types are just coming out, and people don't upgrade as they used to do. It's a 5-year thing there. The personal computers, desktops have been hurt, no doubt about that. So where does that leave one in electronics? Well, you have games and some various other things. Streaming services, some count this morning, there are thousands of those things out there. The cable business is not what it used to be. And even the entertainment business, Netflix and Amazon now make their own movies. More people are moving into entrepreneurial streams. African Americans, Latinos, and Asians getting more entrepreneurial. So that is an interesting thing also. We'll have to, one of these broadcasts, forecasts, delve a little deeper into that, because now we're sort of preoccupied with that. The climate summit, incidentally, ended in Madrid and came to no conclusion, in spite of the campaigning of Greta Thunberg there. And, of course, the UK election there, the Tories are now in power. They promised to leave the EU, that process, at the end of January of 2020 and start a year-long negotiation period with the EU. And we'll see where that goes, and we'll be in future shows diving in there. Good day.